Good afternoon, everyone. Cap A signing in. Cap A stands for Captain A. If you do not know what is that, right? It's me. Hi, guys. First, I'd like to thank you guys for sacrificing a lunch like me, going on a diet, to join us on this webinar on Singapore, specifically on Singapore, where the government is jump-starting stocks and where we are looking out for potential winners from the finance and services industry. While I myself do talk about Singapore stocks on a weekly basis, we think that it's best to get a local expert to share his insight with us on what's happening on the ground. And that today we have Alvin with us. And before I invite Alvin, you are looking at the disclaimer here. We are all licensed by SC. I am licensed by SC in terms of investment advisory, and Alvin is licensed by MAS. And yes, without further ado, let's invite Alvin to start his session. And Alvin is the Associate Director for IFAS in the investment advisory side, and he's the co-founder of Dr. Val, which is a leading financial education platform in Singapore. He has started his investing journey really earlier than me, since 2007. And a lot more insights from him. I shall let you guys pick his brain. And yes, the floor is yours, Alvin.
Thank you, Adrian, for the wonderful introduction. So let me share my slides. I hope you guys can see this. And prefer to keep this interactive. If you have any questions, you can just type in the chat and we will find appropriate time to address them. So we don't need to wait until the end and we do a Q&A. Okay, so anytime that you have any questions, you can just type. I may not answer them immediately, but I will find time, okay, to answer them. And before I begin, I just want to get a sensing. How many of you have already invested in Singapore stocks? It can also be via ETF to get a Singapore exposure, right? Or even funds. Anyone here? You can just type in the comment box. I see what Sharon raised her hand. So I assume Sharon has invested. Okay. I see a 2, okay? Don't know what's the real name. I saw a 2, okay, also raise the hands. All right. So then I take it as the rest have not really invested in the Singapore market. So this would be a very good introduction to the Singapore stocks and what are some of the ideas that you can look at. Okay. And it's actually at a very important juncture, which later I'll explain to you why. This is going to be a series of session that I'll be doing, right? So we are going to start off this session with financial and services stocks. Okay, I'll pick some and then we'll discuss with a bit more details what these stocks are and where are the opportunities that we can look at. Okay, if you want to talk about the disclaimer, right? So just take note that these are for information and education, not so much for advice. All right, so please do take note of that. And the agenda for today is I will give you a broad overview. Just like I talked about, this is an important juncture, right? It's because there are a lot of top-down initiative that is going to stimulate the Singapore stock market. In fact, it has been stimulating. Hence, Singapore stocks have done very well for the last 1 year. But personally, I believe that there should be still room to go, right? Because the policies are not ending anytime soon. There are still more new policies going to come. And the latest development is that Singapore also launched 2 new stock indices, right? So the most famous Singapore stock index is the Straits Times Index, right? The SPDR Straits Times, the FTSE Straits Times Index. And that is the top 30 stocks, right? So now they created 2 new ones. Okay, I'll tell you what it is, and that is actually a very important reference point for some of you who wants to dive into the Singapore stock markets, and you find that, oh, I already have the blue chips, I want to go to the next tier, so what should I be looking at? So these stock indices can give you a clue where these ideas can come from. And lastly, we'll run through, right, 5 stocks that I have picked from the new indices that are in the financial and services sectors. Okay, so same thing, feel free to ask questions if you have any. All right. So this is the important development. It's a very long word, equity market development program. You know, in Singapore, they always like to have a lot of all this kind of abbreviation. Sometimes we Singaporeans also don't know what the government is talking about because there's so many and it's hard to remember, right? So just remember that if you don't remember the full term, it's fine, right? Just remember that Singapore government is trying to rejuvenate the Singapore stock market because it's been dormant for not the last 1 year, right? But the 10 years prior to the last 1 year. Okay, so it has not been doing well in terms of trading liquidity, in terms of stock performance. But at the end of the day, if you look at the fundamentals, which the companies have been growing, their dividends, growing their revenue, growing their earnings, yet the share price don't move up. So there was this mismatch between real business performance as compared to the stock performance, right? Singapore GDP has also been growing for the last 10 years, but somehow the stock market has not caught up. So that prompts the Singapore government to say that, okay, we need to do something about it, and they put a minister in charge. So never before have the government been so serious to put a minister in charge, because in the past it's just probably certain directors in certain government agencies, right? But this is the very first time. And it just goes to show how serious the Singapore government is on this matter. And it did work, right? So once they appointed the minister on it, I think the rest of the investors do see, okay, now I think they mean business, right? So the Singapore stock market did really well in the last 1 year, right? So that is a bit of context what's going on. Of course, it's not just because of this the stock market is going up. There are a lot of other factors as well, right? Adrian and I were just talking about fund flows, okay? So fund flows started to go to Asia, right? Not just to Singapore, but you can see in Hong Kong, even in Malaysia, you do see some of these fund flows, and that helped buoy the stock market as well. So it's a combination of factors, right? But I want to focus more on this policy aspect because that is unique to Singapore, and there are indeed a lot of development going on. Okay, and one of the most important development is this $5 billion equity market development program. And this means that the government or the MAS is allocating this amount of money to fund managers who buy into Singapore stocks, okay, who mainly buy into Singapore stocks. All right. And out of this $5 billion, $1.1 billion has already been allocated. They are not I think they haven't really invested yet. Okay, maybe they already have selection of stocks that they're going to plow the money into, right? So this 1.1 billion has been allocated to Avanda Investment Management, Fullerton Fund Management, and JP Morgan. Okay, these three. And that means there will be more, right? Another $3.9 billion will be progressively being dispersed to other fund managers who will be investing in Singapore stocks. So this itself creates a fund flow for the stock market. Okay, not totally relying on market forces, right? But there is this stimulating program that's going on. And these fund managers did also suggest what their focus is going to be, right? In fact, yesterday they just released the PR, right? Fullerton Singapore Value Up Fund. This is open already, open for subscription in Singapore. They're going to invest 100% of the funds into SGX companies. Okay, it's actually launched already, not 4Q 2025. It's launched yesterday, so a quarter earlier. And then we have JP Morgan Asset Management. They say that they're going to focus on small mid cap in Singapore stocks. That means outside the blue chips that most people are familiar with. Okay, and not just in Singapore, they also have carved out some part of portfolio in other parts of Asia Pacific, but mainly it's going to be small mid cap Singapore. Right, so that's JP Morgan focus. Fullerton, I believe, is more value oriented, right? Given that there's this name value out there. And lastly, Avanda says that it's going to fully allocate to Singapore listed companies with, again, strong focus on small mid cap. Yeah. So the entire government focus is not just on the blue chip. In fact, they are going to focus a lot on the small mid caps. Okay, because the big caps usually don't have problem, right? Getting investments, getting investors. But beyond that 30 stocks in the STI, that's where they want to stimulate demand, right? They want to stimulate more trading volume in that space. Okay, so that's where the focus is going to be, right, in our discussion as well. And SGX also created 2 new indices in the small mid cap areas. All right, they call it the iEdge Singapore Next 50. Okay, the other one is the same index, just that it has a liquidity weighted. Because one of the problem with smaller companies is that their liquidity is lower. It's harder for investors with big funds to buy significant amount without moving the share price, right? Sometimes there's not even enough sellers, right? That you want to buy, not that you can buy, right? It also depends on whether they're sellers. And a lot of these small mid caps are held majority by the founders or the management, and they don't really sell their stock, right? So without that supply, usually it's a bit difficult, right? So that's why you have a liquidity issue. So therefore, having that liquidity weighted index would allow the other fund managers, if let's say there's eventually ETF going to track the index, definitely the liquidity weighted one will be the more suitable one. Okay, but the 50 stocks are the same. It's just the weighting are different. So these two indices are going to focus on the next 50 stocks after the 30 stocks in STI. Okay, that's why it's called the next 50. Okay, and Singapore is one of the largest REIT market in Asia Pacific. Right? I think it's the largest after Japan. Okay, and it's not surprising that there are quite a number, 16 out of the 50 index component comprises real estate investment trusts. Okay, yeah, I think there are like 40 REITs in Singapore, and 16 is captured in this new index. Right, even in STI, there are quite a number, a handful of REIT as well. Right, so there's finance, 7 of them. Okay, so you can see the numbers: industrial 8, non-energy material 6. Okay, the rest are less represented, right? So the 4 sectors that you will see are mainly the REITs, finance, industrial, and materials. Okay, so these are the 4. Of course, the index selection is blind. They don't really deliberately want to choose certain sectors, and that's why you have a very kind of a skewed index. I did feedback to SGX and say that you all should consider having a cap, right? Maybe create a third index and there's a REIT cap, right? So that means you don't have so many REITs. Otherwise, the whole index will have a lot of REITs inside, which may not be beneficial, right, for some investors who want to look at some ideas beyond REITs. Okay, so this is what it looks like, right? So it was just launched on 23rd September 2025, and that's like 2 weeks ago. Okay, so these are the next 50. I didn't print screen the whole thing because it's too many, 50 of them. But this will give you some idea about what stocks are, what are stocks in the list. And you can actually get this from SGX website. You just go and Google search IH Singapore Next 50. You should be directed to the website, and you can download the fact sheet. We will include the constituents of this index. So if you ask me, this is a good shopping list. Okay, because we just now already discussed, right? The development is that the government want to push a small mid cap. The fund managers also focusing on small mid cap. And then now there is this small mid cap index that's came out, right? So it's very likely that the fund flows are going to be going into some of these stocks. We don't know for sure which one are they, but the fund flows are going to these stocks. Okay, so which means it's a good shopping list, right? If you want to shop for ideas, you can keep this list handy and refer to them once in a while, right? To look for opportunities. Okay. So now let me then go through some of the stocks that I picked from these 50, okay, focusing more on the finance and services sectors, right? So the first one is this Yangzijiang Financial. It is a company that was spun off from Yangzijiang Shipbuilding. Okay. So Yangzijiang Shipbuilding is a China company. It's one of the largest private shipbuilder. It's the largest, okay, shipbuilder, private shipbuilder. Okay, because they're state-owned ones. CSSC should be the biggest in the world, also in China, right? Not surprising because China builds so many things, okay, including ships, your container ships, your bulk shippers, whatever, right? All kinds of ships. So Yangzijiang Shipbuilding is a private company and it's the largest as a private shipbuilder in the world. And they are STI component, right? So it's also a blue chip company. Share price also done very well. I think has risen for 3 years consecutively. Okay, they got a lot of orders, basically, right? And financial results have improved a lot. And last time they used to just take the shipbuilding profits and go and lend out the money. Okay, lend out the money to other companies or other borrowers to earn the interest. Right. So China call this, or the rest of the world call this the shadow banking. right? Which is not really allowed because you're not really a bank, you're not licensed as a bank, but you're lending out money. Okay, so that creates a bit of that gray area, right, for this Yang Zijiang. And therefore, in 3 or 4 years ago, they started to discuss, right? They should spin this off into this financial arm of Yang Zijiang Shipbuilding should be operated as its a financial institution, okay, a standalone financial institution. So that was how in 2022, okay, Yang Zijiang Financial, right, the financial arm of Yang Zijiang Shipbuilding became a separate listed company. Right? Of course, Yang Zijiang Shipbuilding still have stakes in this Yang Zijiang Financial. Actually, it's not like it's the boss of Yang Zijiang Shipbuilding have a stake in the Yang Zijiang Financial. Okay, so it's quite a young company. It's only listed as itself for about 3 years or so. All right. So it has quite a number of assets, okay, quite diversified, I would say, right? So you have, okay, the investment portfolio is very small amount, it's not, it's very negligible. Maritime asset, about 16% of the asset base. Debt instrument, that means they lend out money, about 36%. And they also do some equity investment, 10% allocation, and a lot of their money is still in cash, 38%. That's not deployed, right? But there are plans. Okay, so they are forming into like an investment holding company, a financial institution, and also partly operate like a private, like a not private, it's public. It's like a the boss's family office, okay, to invest and grow the wealth. All right, so you're actually investing in a family office per se in that sense, if you want to look at it that way. So there's something happening as well, right? So there is a special situation that you can also look into. Okay, so Fiance Financial is going to spin off one more time. Okay, so they are doing a lot of all these corporate actions for the past few years, and they have announced this already. It's just not happened yet, right? So April this year, YZJ Financial said that they are going to spin off their maritime fund and maritime investment. Okay, so it's going to spin off, and it's going to list sometime in November, pending approval, right? And the implementation timeline. Exact details, exact timeline we don't know yet, but what we know with some concrete announcement is that if you are a Yang Zijiang financial shareholder, you will get shares in Yang Zijiang Maritime. Okay, so this is what we call a dividend in specie. That means they will give you the shares of the newly formed company listed entity. So you own both. All right. So you just think of the current value of the YZJ Financial split into two. Right. So later I'll give you some numbers to give you a sense. Okay. And that itself can be opportunity, right? So in investing space, that's what we call a special situation. Of course, it depends on how the price will move after this split, right? But depending on which one has a much clearer value proposition, usually the price will go up, right? So that's what we call value unlocking or re-rating by the market, because now the conglomerate discount is gone. Okay, so clearer and better valuation of specific assets, especially if they're valuable. Right, so these can be opportunities. Later I'll discuss a bit more on that. So this is the maritime fund, is about 1 billion, and the maritime investment is about 400 million. So it's not small, right? It's a 1.4 billion fund, and only about half is deployed. Okay, only about half is deployed, and they focus a bit more on the ESG side, right? So they must be having some ESG requirements before they invest. So it holds about 75 vessels for this new spin-off, and consisting of tankers, gas carrier, bulkers, container ship, OSV, all kinds of ships. It is required for trade around the world. And again, the geography is around the world. Okay, so it's rather diversified. You can see it as a shipping investment company. It's not a shipping company per se, right? So it invests in other vessels, can also be other funds as well. Okay, so this is the spin-off asset that they're going to do in November. All right, and this is the split, okay, between the maritime and the remaining Yang Zijiang Financial, right? So this will be a YF8, and this will be the new one, okay, the new company. You can see the growth is coming from the maritime investments, right? Profits is going up, the NAV value is also going up, all right? Whereas the rest of the Yang Zhejiang Financial is kind of like flat in terms of the profits, and the NAV is declining. Okay, later I explain to you why the NAV is declining. So from this look, you know that the more valuable business is the maritime, the new spin-off company. Okay. The problem is when you combine, which is now, right? Now Yang Zhejiang Financial is both of this. So when you mix both together, okay, the maritime investment don't get the credit that it deserves because the remaining of the Yang Zhejiang Financial will so-called pull down, right? The average. Okay. So the smart thing when it's spin off, right? My view is the maritime investment unit value will be perceived value will increase while the remaining one will go down, right? So the trick is if the new one go up more than the old one go down, that's where you can have the arbitrage, right? That's where you can make the difference. Okay, so that's what special situation investing is all about. You analyze the deal, right? And of course, you have to make some judgment call whether how the price will move due to the perception, right, from the investors. Okay. So why is the NAV going down, right? It's because you remember I talked about the shadow banking that Yang Zhejiang was doing, right? Way before even Yang Zhejiang Financial was being set up. It has a lot of issue because it has a lot of bad debt exposure in China. Okay, it's your low quality borrowers who may run into problems. They may cannot repay their debt. So it's not a very good portfolio of debts that the Yang Zhejiang Financial has amassed. So there is a deliberate intention to reduce this debt exposure over time. And you can see there is a very quick deceleration over the years, right? Then they deploy the assets to elsewhere, right? Like maritime fund, which is their forte, right? Because they build ships, okay? And in fact, this maritime fund, right, is managed by the founder of Yang Zhejiang, okay? Whereas the core investment is managed by somebody else, right? A professional fund manager. Okay, so you can see that this is still their core, right? Rather than having all these debts that are lent out in China, right? So they are shifting more assets to Singapore, as you can see over the years, right? So that is the cleanup that they are doing. So it's not that the core business is bad or the core Yang Zhejiang Financial business is bad, is that they are just cleaning up the house, right? So once it's cleaned up, there can also again be opportunity of price recovery, right, from here. Okay, in fact, the Yang Zhejiang Financial stock has already gone up, right, because of the this potential spin-off. Okay, so this is just a potential scenario, right? We don't know exactly how it will happen, but there are some mathematics that we should know, right? So now let's look at the NAV, which is the book value of the company, right? So Yang Zhejiang Financial is at 1.17 cents, okay, $1.17. And they're going to split this NAV into two parts, right? Because one will be the original company, the other one will be Yang Zhejiang Maritime. Okay, so the spin-off of Yang Zhejiang Maritime will be worth 63 cents in terms of NAV, and then for Yang Zhejiang Financial will be 54 cents. So once the new units are given to the shareholders, definitely the share price of Yang Zhejiang Financial will have to go down because the value has gone down, right? And on top of that, Yang Zhejiang Maritime is also taking the opportunity to do a 250 million placement, right? So placement is usually done with a few big investors. So I believe one of them is going to be the founder of the company, right? Yang Zhejiang Shipbuilding. So he's going to pump in more wealth into this Yang Zhejiang Maritime. And we also don't know what's the issue price yet, right? So there are some question mark, okay, but these are developments that you should watch out for if you are interested in the counter, okay? So Yang Zhejiang share price will drop, right? And I believe that because the just now we saw this, right? The core business is not as nice as the new one, okay? So it's possible that the new one, the price would trade above the book value, while the core and the existing one may drop below the book value, okay? But as I said, if the YZJ Maritime rises more than the drop in YZJ Financial, right? Because you will still hold both after the split, okay? Then you still have a net gain of it, right? Because the key is that this is a growth asset, and this is a price asset. Okay, once it's being split out, right? the perceived value will increase. Okay, when they are mixed together, there's this conglomerate discount, right? Once you split, it becomes clearer. So that's how some of these special situation can play out. Okay, definitely it's been a lot more complicated compared to if you just analyze buy and hold stocks, right, undervalued stocks, etc. Okay, but some investors, they like this kind of special situation, and so it's depending on your investing style. Have not been hearing shadow banking for some time until speaker's attention on YF8 this morning. Yeah. Okay, but you can see they have an effort of cleaning out, right? So they really want to get rid of that bad debt. Right? Now it's almost really non-existent already. Okay. Yeah. So they not say non-existent, they're redeeming a lot more, right? Redeeming a lot more and not adding more debt to it. All right, so that's the first company. In fact, it's the very first one in the IH Singapore Next 50 index. Okay, yeah, it's the largest weight, in fact. Yeah. So definitely, sometimes you want to look at also bigger ones among the next 50 because fund managers deploying the fund also find them easier to buy. Right? If you buy smaller ones, not easy. Okay. And in fact, this next 50, right? Beyond that, the liquidity really starts to drop. Okay. So another thing you want to look at it is that you're going to put $5 billion likely into some of these stocks, right? There could really be some effect in moving share prices. Okay. Because the liquidity is must be able to absorb that millions of dollars, in fact, billions of dollars. Okay. So second one is this in the finance industry, right? iFast, same as Yangtze Financial is also in the finance industry. Okay. So for iFast, it is more like a growth stock. There's not much of a special situation talking about. Okay, talking about it. It first started off more on funds, right? Unit trust. They have started off with a fund supermart, then they changed their name to FSM1, which is their B2C arm. Okay, but they also serve the other advisory firms, right? So for example, if someone want to set up an independent financial advisory firm, they would also need a platform to execute their trades for their clients, right? You cannot go without a platform. So iFast also do the B2B, okay, to extend their platform to other financial advisory firms to execute their trades. All right. And over the years, they also expanded to other areas, right? And I think one important one is this, two important ones. The first one is this iFast ePension that is in Hong Kong. Okay. So it becomes the de facto platform for Hong Kongers who want to invest their pension. Okay. So they have to go through this platform, right, to process their investments. Right. So that is a very big win in terms of the project. And that also propel a lot of growth for the company, right? Because it's significant. Okay. And the other one that has a growth prospect is the bank, okay, which iFast also bought, I think about 2 years ago, right? It's a very new subsidiary. It's a UK digital bank. They bought over it. And within like less than 2 years, they turned from unprofitable to profitable and with strong growth and a lot of synergy, right? So one is that they can also provide lending and better conversion rate, telegraphic transfers, all these kind of things to other iFast clients, right? So it is this ecosystem that iFast is trying to build beyond just the surface that people are looking at, right? So connecting a lot of different kind of financial services into one platform. Okay. Of course, they make money from fees, trader fees, platform fee, upfront fee, rep fee, conversion fee, whatever fee. That's typically what financial institutions earn from. And this is the product mix. All right, let's talk about geography first. Okay, so starting off with Singapore, of course, it's not surprising that most of their assets are based in Singapore, right? 71%. Okay, and this is Hong Kong, and they have some presence in Malaysia, but not as large as Singapore. And then others is China and UK, right? So Singapore is still the key market because they started off way early, I think 20 years ago. Right? So the rest of the markets are pretty new. okay, relative to Singapore. And in terms of product, same thing. They started off with unit trust, and that's why the unit trust is the largest component in terms of the assets. All right. Second largest is stocks and ETFs. Okay. And then 12.5% is bonds. Right. Then 9.5% is cash and deposits. Okay. So these are the rough allocation where clients are investing in terms of country as well as product. Right. And I think this is something that is a picture that can paint the growth very well, right? So this is the 20-year chart in terms of the revenue. Okay, very consistent growth, and you can see the hockey stick pattern, right? So this is 2025. If you times 2, it will be higher than 2024 already. Okay, so there's this consistent growth. In fact, almost most of the time, every year will grow, except for during financial crisis, right? 2007 to 2008, you can see the crash. Then I think spill over to 2009. And thereafter, you can see that it's generally on the uptrend. There's another dip in 2016. I think that was China, right? China had a pullback, or not a pullback, a crash in that period, if I didn't remember wrongly. 2020 was a very short-lived one, right, for COVID, because after that, the market just boomed. Okay, so you can see a big jump in the growth as well. 2022, there was a correction in US, right, down about 20%. But I think the rest of the Asian markets were still okay, right, still resilient. Then you see the boom in the last few years, right? Especially with the Hong Kong e-pension revenue coming up. So generally, you can see this hockey stick pattern. Revenue is increasing, and in fact, most of the revenue is recurring in nature, right? Because they are likely the rep fee, trailer fees, all these. As long as investors are invested, the fees will continue to flow. And over the last 10 years, the revenue growth rate is about 17% per year, right? So in Singapore, or largely in Asia, you will notice that not many stocks have that kind of growth prospect, right? Mostly are dividend stock, value stocks. Okay, so iFAST is one of the rare growth stocks that you can find in Singapore. Okay. And this is the first half of 2025 numbers. You can see revenue up 26%, profit up 33%, after tax is 37%. I think there's some tax assets. Yeah, you should look at the net profit, right? Up 35%, dividends up 29%. Okay, so this again shows the growth nature of the business. All right. So there are growth engines, not just the Hong Kong e-pension that I talked about, or the iFAST Global Bank, but its core business where it first started off, right? Investing assets for clients or supporting the other financial advisory. The platform itself is still growing, right? So it actually has 3 engines of growth running at the same time. And it's diversifying, right? One in Asia, one in Europe. Okay, so this means that there could be likely more runway of growth for iFAST itself. Of course, there are always risks, right? Not all investment comes with just the rosy side. What are some of the possible risks that can affect iFAST? First is market fluctuation, because at the end of the day, it's a wealth management platform, right? Which means wealth are invested in the markets. If the markets don't do well, the value of the investment will go down, and that would again affect fees, because now the fee will be subjected on a smaller value, right? So the fees will also reduce. Okay, so then the financial performance also go down. So if there is a market crash or whatever, it is very likely you will see the revenue might even decline, right? Depends on how big that drop is going to be. Okay, so take note that you're still subjected to market risk. The business is still subjected to market risk. Second is the e-pension execution and policy risk. Yes, it's scaling up, but there will be teething problems. There have been teething problems, and they are still going to solve more going forward, right? So it's not all blue sky, smooth sailing. Okay? There's a lot of execution risk that's going on, and as well as policy risk, right? If let's say Hong Kong change certain policy, maybe cap the fee rate, then that will again translate to financial impact to the company, right? So this again is not possible for us to predict how the government policy will change over time. Lastly, the iFAST Global Bank, right, is supposed to create synergy in the ecosystem, but integration may not work out as well as people or the management intends to, right? Because it is based in Europe, licensed in Europe, and the wealth platform is largely in Singapore, right? And the e-pension is in Hong Kong. So finance is very difficult to cross country. Why? Because the regulations are different. And that would also pose integration challenges for a global bank. Even though you want, as much as you want to call it a global bank, it's based in Europe, it's regulated in Europe, it's not the same as in Singapore or in Malaysia or in Hong Kong. Okay, so there will be some of these risks that investors need to take note of, right? So basically, yes, there's growth, but there will be a lot of teething problems that the management need to solve, all right? And in terms of valuation, if you look at the forward PE, because of the growth at 29 times, it's not demanding, right? Especially if you look at a lot of growth stocks in the US, the multiples is even crazier than this, right? 50, 80 times PE is very normal. FIRE average 96 times is because the share price have gone up quite a lot over the last 5 years. And that's because of the anticipation of both the e-pension and the iFAST Global Bank. Actually, it's more the e-pension, right? That was a very key driver for the expectation of the growth. Okay, but they did deliver the growth. That's why the forward PE went down. And the PG ratio, if it is less than 1, usually it shows that the growth is worth that PE ratio that's trading right now, right? Of course, this PEG ratio will fluctuate, okay, but as of now, that's what we are looking at. Okay, so that is the second financial company that we have looked at today, right? So same thing, you have a question, just feel free to type in. Okay, now we move beyond financial, we are going into other services. So one is healthcare, right, which is a very important pillar for economy as well as personal well-being, right? And Singapore, of course, is known for very high standards of healthcare service, right? And you know what's the funny thing? Okay, the funny thing is that the largest operator, top Singapore hospital operator, is a Malaysian company, right? It's IHH. Okay, so wait, it owns most of the hospitals, private hospital in Singapore. So Raffles Medical is the second player, right? It has only one hospital in Singapore, okay, and the revenue is definitely not as big, lah, right? So it's about 1/3 of what IHH Singapore segment is contributing. And third one is Thomson Medical, which is also a listed company, but much smaller, right? Half of Raffles Medical. Okay, but it's not just hospital. Raffles Medical also have a lot of clinics that does GP, dental screening, right? An expanded, think of it as an expanded GP. So people can do, like, I think even X-ray and things like that. They have more machines basically. Okay, so they try to fill that gap between the hospital and the clinic, a GB clinic, right? So it's something in between. So more comprehensive healthcare provider, and it's the largest homegrown private healthcare provider, right? Because most of the healthcare is service or rendered by the government, right? A lot of the public hospital are all run by the government agencies, okay? So they also have expanded to China, right? They have 3 hospitals in China: Beijing, Shanghai, and Chongqing. Okay, they want to use the Singapore brand name, especially Raffles is a very nice name, and they want to branch it out to other countries. And China is a no-brainer, right? Considering that huge population, aging population, the healthcare needs is going to be larger. So that was where they decided to go into, right? Which makes a lot of sense. Okay. So let's look at some numbers. All right. Most of the revenue is still coming from Singapore, almost 90% of the revenue. Okay, this is based on first half of 2025. And the growth is modest, right? Just about 4% higher than a year ago. China is still a very small percentage, 8%, and in fact, they suffer a revenue drop. Okay, I don't know whether is it because of the deflationary pressure in China, right? Especially, I think they have some policy on the drugs, right? They have to centralize buying of drugs. Okay, so they press down the prices. So maybe some of this revenue impact could be there. Rest of Asia, I think these are largely the clinics, right, which is very small percentage outside of Singapore. Okay, in terms of the segments, right? Hospital is the major contributor, 40%, and then will be the clinics, right? Which is about 32% or 33%. They also do insurance. Okay, this is something that I think a lot of people don't know, right? So they actually underwrite insurance. They have health insurance, hospitalization plan, all these kind of things, and that has the highest growth, right? And but one of the issue is it's not making money, even though there's good growth, right? But there's underwriting losses. And later I will show you. Right? Actually, it's here. Okay, so we can see that healthcare services. This is the clinics. Profit margin is very good, right? 20%. Hospital services. This is hospital, right? It's about 9%, still decent. But if you look at insurance services, it's -7%. Still have a lot of underwriting losses. And I don't know whether you're aware, in Singapore, the healthcare cost is escalating, medical cost is escalating, right? Some blame it on because of all the S-charge plans. People just stay in hospital and claim the maximum, and doctors who know that you have health insurance will charge you the maximum as well, make the biggest claim. So whatever the reason is that there is this escalating of prices, and therefore the insurers are not making money, right? Because if there's always a maximum claim, it deviates away from the average or the median claim rate that that the underwriting has been projected for, right? So that is something that they haven't get out of, right? But it is indeed a growing business. Okay. The only good thing is that actually I used the 2024 should be this column. Yeah, a bit blur. Okay. One good thing is that you can see that the losses from 2024 to 2025 has halved. Okay, so they are cleaning up the underwriting, uh, um, make it more conservative, basically, more prudent, and don't take on certain policies that do not have a good ROI. Right. So that is the Raffles Medical. Okay. And these are the other financial aspect, right? So one good thing about buying a healthcare related stock, right, is that especially healthcare services, clinics, hospital, is it doesn't care whether the economy is in recession or not, right? It doesn't care whether the economy is booming or not. Whether economy is doing well or not, people or patients who need to see doctor needs to see doctor. You need to pay the money. You cannot say, oh, economy is not good, let's skip it to next year. Health screening may be okay, but if you have a medical condition that you need to treat, you have to go for see a doctor, right, and get it settled. Okay, so that is what a defensive nature of these healthcare services are, and Raffles Medical is definitely in that bucket, right? And it has consistently delivered higher dividend per share over the long period of time. You can also say that every year they have distributed dividends without fail, whether is it COVID, whether is it financial crisis, they have always delivered dividends. Okay, that's the point that I mentioned, right? Because rain or shine, they are going to make money, okay, whether there's recession or not, right? There's some revenue dip in 23, 24, right? But what I want to say is that the general trend is still up. Okay, probably the exception is 2022, like, a lot higher than the rest. Okay, but otherwise, the general trend is up. Okay, if you especially focus on the final dividend. Okay, and the yield has also gone up, right, to 2+%. It's not really the most attractive dividend stock out there. Okay, but defensive high quality stocks are like this. You're not going to get 5-6% on a defensive counter. You're going to get 2-3% usually for this kind of business. Okay, so that is Raffles Medical. All right, and let's look at further numbers. Okay, to show that actually it's reasonably priced, right? It's neither undervalued or overvalued. P for P about 27 times. The past 5-year average is about 25 times. Okay, not much difference. And the 5-year dividend yield is average 25, and the trailing 12 months is about 2.5. Okay, so again shows that it is just reasonable or fairly priced. Okay, if you want to de-risk your portfolio, if especially you have a lot of high beta, a lot of aggressive stocks, then you feel a bit uncomfortable because especially in the US, a lot of all the stocks are seemingly very overvalued, right? You want to go more defensive, right? Definitely stocks like Raffles Medical is one of those consideration, right? For you to gear up for the defensive posture in your portfolio. So opportunity is that it's going to be a steady Singapore business. It's going to be not an exciting growth business, right? It's going to be resilient to economic slowdown. Okay. If China can grow well, right, it will indeed eventually contribute more revenue to the group. Okay. And we talked about underwriting improving. So insurance may turn profitable. That again increase the profits. And if more profits, they may be able to give more dividends as well. Right. And risk is that China gestation period lengthens, okay, because they are still trying to make their China business. We don't know whether is it profitable because they don't break out that numbers, right, in terms of the profits in China. But the sensing is they are not contributing much as of now, right? So it's likely that probably even if it's profitable, it's not very profitable in China. So there are some risks over there. And again, policy risks, right? Same as what we have seen just now for IFAS. Insurance losses continue to mount, right? So if the medical costs continue to escalate, okay, the underwriting may again need new assumptions, right? And in the meantime, they may not make money as well. Okay, so that's your Raffles Medical. Now let's move on to telco. Okay, telecommunication services. They are always good dividend stocks, and StarHub is definitely one of them. And there are 4 players in Singapore, right? Even in a small market like Singapore. Okay, personally, I disagree that we need to have so many players. Even as a consumer, I feel that I don't need so many choices. In fact, give me so many choices, I'm very confused. Give me fewer choices, right? Make my life easier. So Singapore all along had 3 players. Okay, then they added 1 more, right? So the 4 players are Singtel is the biggest, definitely. Then StarHub, then M1, then Simba. Okay, and recently there's some market changes, right? What are some of the market changes? Simba is acquiring M1. So end up 4 player become 3 player again. Okay, that's why I said the market is too small. Cannot have so many players. So back to 3 players. It's not approved yet by the government because they need to look at antitrust, anti-competitive kind of analysis before they agree whether they can buy M1, right? And StarHub has bought MyRepublic, which is a broadband company, okay? And they already have a stake in MyRepublic, but they bought out the rest of the company. And broadband, they are number 1, right? So in terms of mobile, they call themselves number 2, okay? But it's debatable, especially after Simba buy M1, right? It's very likely that Simba will become number 2, okay? After they swallow it, right? So that's why I say it's debatable. Okay, broadband, I think they are indeed quite strong there. Okay, after they acquire MyRepublic. They have a third segment, which is in the consumer space. They also have enterprise, which later we'll talk about it. So entertainment is like the cable TV, right? Which I think in Malaysia will be Astro, right? So we all know that cable TV around the world is not doing well due to streaming, right? From Netflix. Sometimes I stay Airbnb in Malaysia. I always get Netflix one. Okay, so don't even get, I have not seen an Astro for a long time. It's always Netflix. So it's a common issue, right? So in Singapore, it's the same thing. And some still have this legacy business, okay, the cable TV. And yeah, it's a market losing kind of business. Okay, but they're managing it. You cannot just totally cut it out because if you cut it out, then it's still lost revenue. There's still some revenue. You don't want me, right? So take first, okay, take as long as you can. So you can see that the entertainment is down, right, in terms of the revenue. Okay, for the mobile, it's also down. Is because prices have been compressing. Nowadays, very cheap, right? Even they are so competitive that they give you so much roaming data. Right now, a lot of all these local Singapore telco, right? They give you like what 50 gig in Malaysia for you to roam. Okay, last time I still remember when I go Malaysia, I need to buy extra data. Now I cannot even finish using. Right, I can even like stream Netflix in Malaysia. Also can. Yeah, I don't even need to save on data. I don't even need Wi-Fi. I still cannot finish the free data that's given. by the local telcos. Okay, so there's this very strong competition, right? It's commoditized. Mobile data today is commoditized, right? They can't really make much from it. The prices are going down and down and down. I think it's the same for in Malaysia. Broadband, they see some gains, right? So Singapore now all run on fiber, right? Not on all those older telco lines or cable lines, right? It's all on fiber. Okay, so there are still people switching to fiber from enticed lah to switch to fiber. Okay, and rather than using the legacy ones, right? So yes, there's drop of revenue, overall revenue for the consumer side, right? So this is a consumer business which we understand better. Okay, but StarHub has also the enterprise business. That means B2B. Okay, this is probably a bit more complicated, right? Just think in terms of they sell a whole suite of products, right? Could be business broadband, which charges at a different price, right? Business broadband is like double or triple the prices of home broadband. They can do it because businesses are suckers, lah, right? You have to pay business rates, not subsidized residential rates. Because business are usually has more money than individual, so they can charge more, and they will charge more. Okay, so that's what they do. And they also have beyond that, they also give cloud services. They also manage networks for them with cybersecurity, right, under one simple money plan, right? So it's like a list of things that they can subscribe to, what kind of services you want. And just think in terms of that. So that's the enterprise business, and that's doing well, right? You can see essentially revenue growth. Okay, cybersecurity, in fact, is the one that grows the most. And we know that in this digital world, with a lot of hackers and scammers, so cybersecurity is something that is no longer luxury, it's a necessity. Okay, so it's also reflected in StarHub's enterprise growth. Right, so consumer is not doing well, but enterprise is doing well. Okay, so overall, still reasonable, right? So what we are seeing is that we discussed margin are getting squeezed. Entertainment wise, the cable TV is disrupted, and they are just adapting now. They are moving to ads. Forgot to tell you. Okay, they're moving to dynamic ads, right? Something like what Google does or Facebook does. You know, every one of us see different ads when we surf Facebook or search Google or Instagram, right? It's because it's personalized. Okay, so StarHub is also doing something like this. They have an ad engine to deliver dynamic ads to different viewers, right? To make the ads more effective. Okay, so they're also adapting, not totally doing nothing. Broadband is still growing, right? They can raise price, they can package a lot of things. In fact, I used to use M1 broadband in Singapore. I switched to StarHub, right? Because why? They give a very good deal. Okay, so they give you the broadband, they give you Netflix subscription plus Premier League access. Wow, okay, so all three in one, and the price is the same as I go with say M1 for the same service. Of course, I go for StarHub. Okay, so some of this kind of packaging are winning, right? So even my neighbors also got it, right? So you can see that they are doing something, right? With the growing the business, growing the market share. Okay, enterprise is definitely the one that is powering up the growth. Net off maybe no growth, right? But you can see at least there's something that's growing within the business. While a lot of other business is a landscape issue, right? It's not just their problem. The whole ecosystem is suffering. Mobile compression and entertainment disruption. And as a dividend stock, it still pays 5.4%, right, in Sing dollars. Okay, it's a rather good yield, all right? And it has 21 years of consecutive payout. Okay, so they have never skipped a year. So that again is something that a good trade for being a dividend stock. Okay, I think among the 5 stocks that I talk about today, this has the highest yield. All right. So it's also resilient to slow down. Right? You're not going to cancel your mobile or broadband because it's a recession, right? It's nowadays data, internet is a need, it's not a want anymore. Okay, and it's a stable dividend stock, right? So not for growth, okay, but more from a dividend growth. So today I also want to give you different flavors, not just in different industries, but also different kinds of stocks that you can look at. Okay, now let's move on to the last one. All right, LHN. I think most of you have not heard of this before. This is not a component in the next 50 index. Okay, the rest are all next 50 index components. This LHN is under the eligible stocks, additional eligible stock. That means it could have been in next 50, but it didn't manage to squeeze inside. So SGX also keep this list, okay, which I think is also relevant, right? So there are these two lists that you can refer to, okay, all in the same file. Excuse me. So you can actually download it and use it as your idea list. And this also is a special situation play, right? This is a very, I would say, very special, unique kind of property services. You also have facility management, right? A very small part of property development, but they are mostly services. Okay, something I find unique about them, right, is that they will go and hunt for those kind of very odd, underutilized spaces, especially from the government. There's a building that's just abandoned, nobody use. Then they'll go and approach the landlord, right? And then they'll take over the whole space and they will just sublet to a lot of other operators, and they will make the space a bit different. Okay, I have this first-hand experiences because they are my landlord. Okay, they are my landlord. I rent a space at Work Plus Store, right, for my business, Dr. website. Okay, indeed, really now become a storage because I don't go office every day. In fact, I don't go office for a long time. It's really just to store stuff. So we got an industrial space there, and it's very unique. They carve out the space is not very big. I think it's about 200 square feet. Okay, it's just a very small space, storage room. And what I noticed, right, is that a lot of small e-commerce players are there. Okay, why? Right, it is the trend that a lot of people are also running their own online stores, right, to sell their stuff on Shopee, Lazada, or even TikTok Shop. Then you need a proper space to store your stuff and fulfill, right? And you don't want to clog up your house. Okay, so this is a good upgrade, right? A big enough space for a one-person e-commerce store, for example. And they even have like services, delivery services that you can engage to help you fulfill your items. All right, so that's why I say that they are very smart in the sense that they get a space, they carve out the space for a particular usage. Usually is a trending segment that most people would have, or most landlord would not have paid attention to it, because a lot of the industrial, right, spaces are very big. Okay, you're gonna rent like what, 20,000 square feet. If you're just a one-man e-commerce store, why do you need a 20,000 square feet? Okay, so that's the niche that they come in from, right? So I find that they are very good at catching these kind of trends and segmentize the market very well. Then there's also this Wu, which is a co-living brand in Singapore. In fact, I think it's not just in Singapore, like also in other countries, but mainly in Singapore. Co-living is also a very big trend, growing trend as well. And Wu is the biggest, if I'm not wrong, okay, in Singapore. Depends on the sources, right? I think 2023 source says that it's the biggest. We don't know today in 2025 whether it is the case. I think it is. Okay, and same thing, they catch on this trend, right? A lot of people find that, wow, they want a better living space. They don't want to or short-term leasing, because in Singapore rental is usually what, 2 years, right, or 1+1. Okay, you need to commit. And co-living is good in the sense that you can rent for like 1 month, right, or 3 months. Okay, so it again fuel a different kind of segment of the market that traditional real estate would not be able to fulfill. Okay, so they have other things like this is a shared office, right? Of course, WeWork power the idea about shared office, but a lot of other companies have followed suit, okay, and offer their own as well, right? But bottom line, what I want to share with you is this company does this kind of thing. Okay, they take property that looks normal, they convert it and add value to it, and try to capture a segment of the market that is underserved and is riding a growth trend. So they're very good. Okay. They also do facility management, energy resources. All these are the smaller businesses, right? But these are considered integrative services that they can add on to whatever property they already have, right? Because if you run the shared office, if you run the industrial space, if you run the co-living, you also need all this facility management. So they're already doing it. And then they also extend this to other properties, right? So very smart. Okay, so they are very efficient and very good at squeezing margins here and there. Very interesting company. All right, so it's a rather diversified revenue base. Residential is the biggest, 31%, and the highest growth, right? Co-living. Okay, facility management is also a big part of it, right? Because there's so many business property to manage itself, 11% growth. Okay, industrial is smaller and slower, right? Property development is a small amount, okay? Commercial is also a small contribution, right? So mostly from co-living as a big contributor. And what's a special situation here is that okay, so these are just pictures, not important. I just want to skip to the special situation over here. So they are going to spin off the company, okay, the Collywood, the co-living company. Probably this will be the very first co-living company that's traded on the stock market. And in Singapore, confirm is the first. Okay, other country I don't know, right? I've never heard of one. So this could potentially be globally first co-living company, right? So you don't need to buy your own property and convert to a co-living, okay? And you can just buy the company and get onto the co-living trend. It's not going to be a dividend in specie. It's not the same as Yang Zijiang Financial, right? The very first one I talked about. In this case, it is going to be the LHN, which is the parent company, continue to hold a big stake in Collywood. So whatever money that they raise in the IPO will go to LHN, okay? And then LHN may use the money to grow other businesses, right? The only good thing is that if Collywood can list at a very good price, way above the NAV especially, then they will raise more money for the parent company. So then LHN itself value will increase. Okay, and you got an indirect stake to Collywood as well. Right? So that is the special situation over here. It's one of the largest co-living brand, as I mentioned just now, right? In 2023, it was number one based on this source, okay, with a 20% market share. In 2025, definitely within the top five. And the top five, these five brands, control 65% of the co-living supply in Singapore. Okay, so definitely is one of the major players. And if it can be a standalone listed company, it must have a reasonable size. Let me see. Okay, actually not very big, 26 million. Right? It's still a small cap, very small cap. But that's the nature of a co-living space. Okay, so it has over 2,000 rooms, over 400 properties, right? Over 25 locations. Okay, occupancy is very high at 95%. Okay, so that is your LHN, very unique company. Okay, special situation play, value unlocked as Collywood may trade at higher valuation, right? So that's why I say they will create more IPO proceeds for LHN. Okay, if they cash out some of the cash out some of the shares, right? If they don't cash out some of the shares, then Collywood will get a lot more capital to expand, right? So if Collywood raise more money, the value increases. Indirectly, LHN stake will increase and LHN value also increase. Okay. But of course, I also suspect it's the same case where Collywood, because of higher growth rate, will garner a much higher valuation than LHN. Okay. And now the 4P is about 11.7 times. It's not very demanding, right? So this looks like those kind of value zone. And that's also because LHN has been very undervalued for a long time. Single digit P for a long time. PE ratio of 0.21. Again, not demanding, right? Less than 1. All right, so that's the end of my session. Summary is that Singapore stock market is having a rejuvenation plan and is showing momentum. Stocks has done well. I will turn your focus to this Singapore Next 50 index, and today we went through 5 of them. 2 have special situation, spin-off coming up. YZJ Financial, Yanzia Financial, and LHN. If you are looking at growth stock, iFast can be one idea. If you're looking at dividend stock with a 5.3% yield, is StarHub. If you look at de-risking your portfolio, going more defensive, healthcare, Raffles Medical is one such option. All right. So yes, that's the end of my session. Okay, I see there's a question. Did you answer?
Yeah, go ahead,
Okay.
Alvin. I mean, thanks for the session. It's obviously very informative. The depth is there. and you're kind enough to actually give a few stock ideas that first you have growth special situation where if you take a view, there's a very good opportunity to make kind of save money. Uh, Growth is fast. Dividend Starhub has been really steady. In fact, looking at the chart just now, checking it out, Raffles and Starhub is actually quite tempting to actually at this level also. But yeah, I'll uh, leave Madam Lui to you on her questions.
Okay, thank you,
Yeah.
Adrian. So one question is, given Singapore economic structure and familiar repeated forward policy, unsurprising that the smart speaker focuses on telecommunication financial. Oh, okay. So that's a compliment. Thank you very much. Okay. No, not smart speaker. So just sharing, and I try to relate as much as possible and share my personal experiences, right? Because some of the companies that I do have, I'm a consumer myself, so I do have that kind of consumer feedback and experience to share. Depending on circumstances, ordinary investors seem to lean on growth, value, or dividend stocks, but which is relatively better? Okay, is a very good question. At the same time, it's not a very easy question to answer. Okay, yeah, I always find that the Bruce Lee philosophy is very good when it comes to investing. His philosophy, right, or what they call the 截拳道, right, is not about one school of thought, right? He actually learned from a few schools of thought. Okay, how the kung fu, there were many styles, right? And people always argue, my style is better than yours. Okay, so I think it's very similar to the philosophy that Bruce Lee don't believe that there is one best school of thought. Each person is different, and it's how you incorporate the particular school of thought or style of fighting, right, into your own, right? You modify it. So same thing as investing. If you ask me, growth, is it better than value? Is it better than dividend stocks? Okay, nobody can give you a clear-cut answer. It's more of which one resonate with you the most. Which one do you think you can do better in? Okay, in terms of performance as well, right? And some other factors can be which one meets your investment objective better. For example, if you're a retiree, if you need cash flow, then it's very clear that dividend stocks is likely the more relevant one. Okay, so that's in terms of objective. If you're a young person and you want to maximize your growth over long horizon, then likely growth stocks is something that is more suitable. Okay, if let's say you are someone who's old school, oh, I always like to buy cheap, sell high, man, buy low, sell high, buy low, sell high, then net value will come very natural to you. Because I would say that there isn't a one size fit all. And the funny thing is that value and dividend are usually closer, right? Growth and value usually are quite different. And there are periods where growth will do well, there are periods where value will do well, right? And even if you look at markets, in Asia, most of the companies are value stocks or dividend stocks. Even in Malaysia, right? A lot of dividend stocks, value stocks. Singapore is the same. You look at Hong Kong, it's also the same. The only difference is at least Hong Kong got more tech stocks, right? The rest of Asia don't really have a lot of tech stocks. So not much growth, right? So if you pick Singapore and Malaysia stocks, likely they are going to be value or dividend most of the time. So it's also in terms of geography. So there are many of these factors. Very difficult to say that which is the best style, right? iFast is a rare one with growth stock. There are some other growth stocks, but few and far in between. I think less than 10. Okay, less than 10 growth stocks. Okay. Okay, next question by two is what about, I hope I answered the questions. Okay, if you're not clear, you can ask again. What about the three big banks? Definitely can consider, but that's why I say that the focus, even from a policy standpoint, right, it's going to be beyond the top 30 stocks in Singapore. It's going to be your small mid cap. I would say at least in the next 1 year, right? It's going to be the focus area. Nothing wrong with the big banks. You can definitely look at them. They are good dividend stocks. Okay, they are not really growth. They have a bit of growth, but not really growth stock. But they are more dividend focused. Okay. The reasons given in the intro, the reason behind somebody saying that Singapore is now ahead of LSE as preferred IPO destination. I would say because the market has came alive, right? There are more people trading, and when there's more people trading, the valuation is better. You think about it, right? If you are a boss of a company and you want to go IPO, you want to IPO when the market is bullish because you can get a better valuation. If the market is not good, right, maybe you get a, I don't know, PE 10, people don't want to buy. But if the market is good, right, you can go and list at PE 20, for example, and people buy, right, oversubscription. Okay, so whenever a market is alive, when the market is bullish, you will see more listing. I still remember even for Bursa, right? I think sometime like last year or beginning of this year, quite a lot of listing.
Almost once a week.
Yeah, exactly. A lot of listing there. Okay, and some companies I also know, right? I firmly remember the Causeway Link, the bus one. I can't remember.
Yeah, high
Yeah.
mobility.
Yeah, correct. So there are 99 Co as well, right? So there are a lot of all these
Yep.
companies that started to this. Okay, so I do think that it's just a function of market activity, right? The more bullish the market, the more IPO there will be. Okay, DBS is more than 2 times book value. Would this be a concern? My view is that we cannot look at book value from a static standpoint, especially for banks. Okay, the reason is because let's say they have a capital base of $10 billion, right? Definitely more than that, but for example, okay, if interest rate is near zero, with 10 billion, I cannot make much as a bank, right? Because the interest is low, I cannot charge a lot. Okay, but if the interest is at 3%, my 10 billions, I can make a lot more money. Okay, so using book value when the interest rate regime has shifted a lot over the last 5 years, right? I think it's not as valuable, right? If the interest rate is very stable, then I think the book value is very consistent. Because if you look at the book value, right, you can see that, oh yeah, it's trading at very high book value compared to history. But if you look at, if you use PE ratio, right, you realize that, hey, actually the DBS don't look that expensive. Because they can squeeze more earnings out of the same amount of book, right, compared to the past, as interest rate have risen in the last 2 years. Okay, interest rate is back down, but it's not near zero, you see, right? So I do think that I don't think that is stretch, right? It's definitely not cheap, but I don't think it's stretch, okay, in terms of valuation. Any recommendation on AI related stocks in Singapore? Okay, first thing is we cannot do any recommendation. Then second thing is that in Singapore, not many AI stocks. Most of the AI stocks are going to be in US, right? You only can get a bit of that downstream impact. For example, I think I can't remember which company already. When NVIDIA invested in Intel spiked up, right? So there was a company in Singapore which have a bit of supply to Intel did well. Okay, so it's gonna be this kind of lower down the chain effect, ripple effect. Okay, but most of the core action of AI is not going to be in Singapore. Okay, we are an adopter of AI. We are not a creator of AI, right? So the value will be captured by the creators, not the users or the consumers of it, right? We have to pay a lot of subscription, right? Okay, this AI stuff. Okay. What about talk
AI
of AI
bubble,
bubble, right? So this is an ongoing thing. AI bubble has been going on for 3 years already. NVIDIA has been going on for 3 years already. I will refer to the latest, I think, an interview done by Jeff Bezos, right, who used to be the boss of Amazon. And I thought that he framed it very well. He said that there are 2 kinds of bubble. One is a financial bubble, one is the industrial bubble. Okay. So he gave an example, right? The financial bubble is at the 2008, where it is because of bad loans, mortgage packaged into seemingly good loans, and eventually everything blow up. That's a financial bubble, right? There is no value add to the society. Okay. Then he used an example of a biotech, right? So biotech is an industrial bubble. There was a period where biotech stocks were very hot. Okay? If you are just biotech, you win really. Your stock will just go up. And at the end of the day, when the bubble bursts, right, they are still going to be winners of it. And even society will be benefiting from it because there are new cures that come out from it, right? Previously, uncurable disease become curable. Okay, so there is a total value add to the society. So Jeff Bezos says that this AI bubble is an industrial bubble. It's not a financial bubble, right? So yes, it will burst. Okay, some of the AI stocks will die, but there will be winners that will stick around. And overall, the society will also benefit, likely because productivity will go up. Very important in aging society. Okay, Singapore is also an aging society because you just don't have enough labor. It's not that you don't hire, sometimes you don't have enough labor, and AI can then boost that productivity. Because economy is labor times productivity. If labor goes down, productivity will go up, your economy will go down. Right? So it's actually a godsend, okay, for aging economy, for aging population. This AI productivity is hopefully it holds a promise, right? Yeah.
Just a question from me, just a view, Alvin. Looking at LHN, right, on what
Mm,
they do seems
mm,
quite interesting,
mm,
and the business is actually closer to Centurion.
mm.
Would you think that in the event that they do the spin-off like Centurion did, right, there could be a immediate reaction to the mother share
Confirm,
where
confirm,
the retracement is actually quite sharp?
confirm, right? Because LHN, the share price also gone up, right? Very similar
Mm,
to Centurion, which you are sharp to point out. Even their property services, all these are very similar. Just that for Centurion, it's more on the workers' dorm, yeah, and
correct.
student accommodation, right? But it's still property services. So it's very likely that people are buying up, right? Because of this so-called special situation, the spin-off is going to happen, okay? And also the overall bullishness of Singapore stock market. So when the spin-off actually happens, the price of the mother share will drop, right? There are
Correct.
at least two reasons. Okay, one reason is because once you spin off, the stake in the new business will change,
Correct.
right? Right. So it depends on the price that they raise and also the market cap of the new stock. Okay.
Mm,
Sometimes actually the value can go up. Actually, for Centurion case, the spin-off was very successful because the REIT actually went up in price. I think
yeah.
got close to 10%, right, in a day. So by right, Centurion mother share should benefit from the increase in price, right? So then they sell down. Why? Then that's the second thing, right? It's the common, it's the what the adage says, right? Buy the rumor, sell the news. Okay, buy the rumor, sell the news effect. Always like that one. When they know that something has happened, people buy up. Then when it actually happened, people sell down because people take profit. Okay, so that creates a sharp reaction. So I don't know whether how I believe LHN mother share will come down. Okay, but I don't know whether the situation is going to be exactly like what Centurion is going to be, because for Centurion they already announced next year they're going to give the REIT shares to Centurion shareholders. There's a promise. Okay,
Mm,
so there's something to look forward to. All right, but I don't know whether LHN will promise that to give Hollywood shares to the LHN shareholders. That one is not known yet, but for Centurion it's known. We just don't know how many shares. We just don't know when. Okay, they just keep it a secret.
mm. I think that's, I guess when we see a special situation like this, we can take opportunity on it. We also want to, I wouldn't say time. If the expectation has right kind of high, it's a good
Mm.
practice to actually take some off the table.
Yeah, yeah. You
Yeah,
take some profit. Some people like to, like, if the stock double, like sell half, then I take back my capital, let the
yeah,
rest go. Right? So that can also be done. Some could be that after the spin-off, then if the price dip to a certain level, they buy, right? That can also be a form of a special situation, because then the it could also be an overreaction on the correction, right? So
yeah,
there can be many ways to slice and dice, lah. Of course, a special situation is takes more analysis. It's
yeah.
not as
Lot,
straightforward. It's not
lot
so
of effort,
yeah, not so straightforward.
and the thesis might not go to the thesis, right? The outcome might not be as the thesis, lah.
Yeah,
So that's why we need to take a view and
yeah,
also stomach the risk.
yeah.
But
That's
yeah,
why dividend stock is easier, right? You just buy and collect the dividends. don't need to think so. As long as the business can sustain the dividends, then yeah, easier. You don't need to think about all this. If this happen, what will happen? If that happen, what will happen?
I mean, I'm considering a personal loan in Singapore to take up a 5-6% yield, right? That's like pure arbitrage. But yeah,
Yeah, but Sing dollar is good. Yes, Sing dollar is good. That's also
yeah,
another
then I
advantage.
wouldn't have the currency risk, just interest risk. That's all, and
Yeah, yeah.
share price.
Yeah.
Okay. So far, I think, is there any more questions from the floor? We are actually making Alvin work overtime here now.
No problem.
Very kind of him. So, okay, if there's no more question, I always say that champions do give feedback. There's a feedback form there. Please do fill it up so that we can tap into your brain of what we can improve on and also try to organize something along the line. And last but not least, I'd like to thank Alvin for his time, his lunchtime. Today we all diet together.
Thank you for having me. Yes,
Yeah,
keep the diet.
and it's time to actually guide us through what's happening in Singapore from the government's perspective and effort, and his details in the individual stocks that he have actually pointed out so that we can study it easier. It's not an investment advice, but what he have done for us here is he have laid down the structure of each company, what do they do, and help us understand it a lot quicker. And yeah, that's all from me. Thanks, Alvin.
Okay, see you the next session.
Next session. And thank you, Sarah, for organizing this also.
Thank you.
And you guys are awesome for dialing in. Thank yourself too. Okay, bye.
Bye bye.